Welcome to this explainer. Look, if you've ever stared at a chart and felt like you were just looking at pure, unadulterated chaos, you are definitely in the right place. Today, we're taking a journey together to transform that dense, intimidating web of starting to advanced price action, SMC, ICT, and all that good stuff into a crystal clear, step-by-step roadmap for your trading journey. We're going to bring everything into perfect focus.
So you really have to ask yourself, is the market just a bunch of random, chaotic lines bouncing up and down, or is it actually telling you a story? Well, spoiler alert, it isn't random at all. It's actually a highly specific narrative of the past that dictates exactly where price is going to go next. Why? Because the market is constantly hunting for one thing, and that is liquidity. Once you understand how to read that story, I'm telling you, everything changes.
Here's exactly how we're going to break this down today. 1. Decoding advanced market structure. 2. Spotting those institutional footprints and order blocks. 3. Breaking down liquidity, bias, and time. 4. Getting your trader's mindset right. And finally, number 5, putting together your step-by-step roadmap.
All right, let's jump right into step 1, decoding advanced market structure. First up on our map is BOS, or break of structure. You've probably seen this a million times. A break of structure simply confirms that a trend is healthy and continuing in its original direction. Just imagine the price moving up, taking a quick breath with a pullback, and then powerfully pushing past its previous high. That break right there, that's your BOS. It basically validates that the trend is still very much alive.
But what happens when that trend hits a brick wall and fails? Enter the chotch, or change of character. This is when price is comfortably cruising in one direction, but suddenly reverses and forcefully breaks the last structural low or high. A chotch is your very first major warning sign that the market's narrative is shifting. The story is changing, and you absolutely need to pay attention.
Now, as you know, the market loves to play games, which brings us to inducement, or IDM. Think of inducement as a trap. It's a final pullback or sweep perfectly designed to trick early retail traders into entering the market in the wrong direction, or baiting them into putting their stop losses in really obvious places. The market sweeps up those early participants to grab their liquidity right before executing the real move it originally intended. It's sneaky, but it happens all the time.
To actually read this map correctly and sidestep those traps, you have to track market swings across multiple levels. Advanced structure mapping requires you to distinguish between short-term, intermediate-term, and long-term highs and lows. By mapping the long-term high all the way down to the short-term low, you anchor yourself in the broader context. You'll always know exactly where you are in the grand scheme of the chart.
And this brings us to one of the most powerful, mind-bending concepts in advanced price action, the fractal nature of the market. What this means is that the price action you're observing on a higher time frame is creating the exact same structural patterns on a lower time frame. The identical accumulation and sweeps you see on a massive daily chart? Yeah, they're playing out right now in miniature on a 1-minute chart. It's like a giant puzzle made of identical smaller puzzle pieces.
Okay, moving on to section 2, institutional footprints and order blocks.
The absolute most obvious footprint you're going to see is the fair value gap, or FVG. When massive institutional players enter the market, they bring incredible volume with them. This causes the price to display so aggressively that it creates a literal gap, or a volume imbalance, usually visible between a sequence of 1 to 3 candles. This rapid movement leaves a void of liquidity the price almost always wants to naturally gravitate back to and fill.
Alongside those gaps, we have order blocks. These occur when institutional money steps in right at a reversal. Now, to truly trade like a pro, you need to recognize a few key variations here. An advanced order block uses Fibonacci tools on wicks to find premium or discount zones. Then we have mitigated blocks. They form on the same side, but honestly they work a bit less accurately. Breaker blocks are crucial because they sweep liquidity from both sides of the market before making a run. Rejection blocks happen when candle bodies refuse to close past a swing. They literally just give it a little tap. And lastly, reclaimed blocks, which tap a point of interest, reverse, and use the opposite swing. Knowing exactly which block you're looking at helps you pinpoint your absolute best points of interest.
Let's dive into section 3, liquidity, bias, and time.
So the bottom line is this: liquidity is the market's fuel. The market does not just wander around aimlessly. It actively hunts for liquidity to power its next major leg. And where does this fuel rest? It sits right there in the form of stop losses, located just above and below major swings, previous daily highs and lows, and of course, those inducement traps we talked about a minute ago. Price taps those levels, grabs that fuel, and then fires off.
Now, to figure out exactly where that fuel is taking us, we have to determine our daily directional bias using higher time frame formulas. Basically, by analyzing how the daily candle forms, we can predict the market's intent. If a daily candle forms an open, drops to a low, rallies to a high, and then closes, that's an OLHC pattern, which gives you a solid upside bias. On the flip side, an open, high, low, close, or OHLC pattern strongly indicates a downside bias for your trading day.
Knowing your bias is awesome, but how does the market actually deliver the price? It does it through the AMD market cycle. This three-step cycle happens relentlessly across literally all time frames. First, the market accumulates orders in a tight, boring range. Second, it manipulates the price, usually faking out in the opposite direction of its true intention, just to grab liquidity and trigger those stop losses. And finally, it distributes the price powerfully in the true intended direction.
But remember, when you trade is honestly just as important as what you trade. You absolutely must map your current dealing range to see if you're buying in a discount zone or selling in a premium zone. And then, you wait. You have to patiently wait to execute your trades only during high-volume session, kill zones. We're talking specifically about the Asian, London, or New York sessions, because that is where the institutional algorithms are actually awake and active.
Which brings us to Section 4, the trader's mindset.
2 to 6%. Look, this isn't just a friendly suggestion, it's a lifeline. This is the absolute maximum capital you should ever risk on a single trade, and frankly, ideally, you're risking even less than that. Your primary job as a trader is actually not making money, it's capital preservation. If you protect your capital fiercely, I promise you, the wins will eventually take care of themselves.
To avoid blowing your account to pieces, you have to operate like a machine, guided by strict psychological survival rules. You need total detachment. Cut your losses quickly when your setup invalidates, and have the patience to hold your profits when you're right. You cannot allow fear, greed, or some false sense of urgency to dictate when you click the mouse. Journal every single trade, stick rigorously to one defined strategy, and absolutely never overtrade. Discipline, more than anything else on the chart, is your greatest edge.
All right, Section 5. Let's pull it all together into your step-by-step roadmap.
Here is your definitive daily checklist. Write this down. First, always start by analyzing the higher time frame trend and narrative. Next, map your current dealing range to lock in your daily bias. Then comes the hardest part. Wait. Wait for a clear liquidity sweep or an AMD manipulation phase to play out. Once that happens, locate your precise point of interest, like a solid order block or a fair value gap. Finally, zoom in and execute your entry in a lower time frame kill zone. Always with a strict risk-to-reward ratio completely fixed before you even think about placing the trade. I want to leave you with a final, slightly provocative thought. If you analyze the charts today and you don't find your perfect, high-probability setup, just walk away. The market is literally always going to be there tomorrow, and the only question you really have to ask yourself is, will your capital be there to meet it? Thank you so much for exploring this breakdown with me today. Keep studying these concepts, stay incredibly disciplined, and above all else, protect your capital. Catch you next time.